Welcome back. Time now to revisit what's been a hot topic this year for investors, high-frequency trading. Michael Lewis stirring up a ton of buzz on Wall Street after his book, Flash Boys, said the practice made the stock market effectively a game. One of our next guests penned a response called Flash Boys Not So Fast, and in the book claims Lewis got it wrong and high-frequency traders actually save investors money.
All right, let's talk with him and a few others. We've got author Peter Kovac with us. Along with him, we've got Tom Joyce, now the executive chairman at Arxis Capital. And also with us is Dr. J from OmstronMonster.com, and, of course, the CNBC contributor as well. Thank you. We don't have time to go over the whole book, but give us the highlight. Where did Michael Lewis get it wrong on high-frequency trading?
Michael Lewis got it wrong when he said that high-frequency traders are front-running the public markets. What he alleged is simply impossible. Today's markets don't work that way. So in my book, I go point by point through his allegations and dissect each one of them and give numerous reasons why what he alleges is simply impossible.
So there's no problem. John and Jerry, are you concerned about the individual investor getting ripped off by high-frequency trading? Is there ultimately a point to what Michael Lewis is arguing or no?
Well, unfortunately, I think he wrapped it in almost a PR stunt, though, Kelly, as far as to grab headlines and saying that the individual investor is being ripped off, the market's rigged. It's a bad message to send.
Having said that, though, you're no fan of high-frequency trading, are you?
I'm not a fan of the parts of high-frequency trading that I think are the bad parts, the parts where you get a faster data feed by virtue of paying up to get it from, like, Edgar, for instance, for SEC filings bill. So, in other words, that's filed, and these folks that are going to disclose that they have a 13D or whatever it might be,
right,
that should be available at the same time to everybody. Now, if you have a faster connection, so be it. So I'm not demonizing folks just because they trade fast. People that provide liquidity, I'm all for it. It's the folks that are gaming the system that I'd be against.
Tom, I was at an investment conference not too long ago, a couple of weeks ago, as a matter of fact, and a lot of the questions from the floor had to do with high-frequency trading. They had all obviously read Michael Lewis's book, and they were worried about the effect it had on their individual portfolios. Should they?
No, that is a complete canard, frankly. There's something called internalization. It's a trading style that a lot of the execution destinations like Knight Capital did, Citadel does, we will at Arxis Capital do. It's called internalization. Retail orders are held. They are sent off board usually to an internalizer. They get executed immediately. The high-frequency trading community never even sees a retail order. They can't interfere with it if they don't see it.
It's a separate track.
And that's exactly what. And by the way, we did reach out to Michael Lewis and Brad Katsuyama, who runs IEX, now formerly of RBC. They weren't available today, but Peter, there are moves in the market responding already to some of these issues. Notably, RBC, IEX, and others are almost trying to do away with the whole maker-taker premise here. Do you think that's where this is going? In other words, are we making needed reforms to the equity market structure, or no? Is there no problem at all to reform?
Well, absolutely. We've been making many reforms to the equity structure, and that's been proceeding. But it's interesting you even mention IEX because with Flash Boys, even they've been backing away from the book. They recently called it, and they're the main characters of the book, and they've called it sensationalized and salacious. And, I've got to agree with them. The Flash Boys is sensationalized. It is salacious, and it's dead wrong. And it's detracted from the real policy debate we should be having.
Have you seen a change in the tone of the market as a result of Michael Lewis?
Well, we've seen, Bill, and it wasn't just from Michael Lewis's book, of course, because we have seen prosecution of firms, Athena Trading with this so-called gravy algorithm, and a bunch of others that were either doing spoofing and loading the market with bad quotes and things like that.
With the last second.
Yep, and any ways that can be out there to manipulate the market. Now, these were things that were done, again, way before the Flash Boys book came out. The fact that you shine a light on it, great. Make the bad players pay for their crimes. But if it's just providing liquidity at high speed, I don't have a problem with that. So I think where people need to draw the line is if somebody is jumping ahead of somebody because they have some ability to do that, then that's bad. Those people should be taken away in cuffs.
Peter, last word.
Absolutely. If someone's doing something wrong, they need to be prosecuted. End of story. But high-frequency traders, on balance, are saving investors money. Today's markets are faster, cheaper, and safer than ever before.
And I got to say, I mean, I'm thinking about those people who were concerned about this at this investment conference, and I'm talking to Tom Joyce, who's an insider in all this. Of course he's going to defend, the way that high-frequency trading is handled, right?
When I was we were doing 4 million trades a day. High-frequency trading never came into it. We didn't co-locate. We didn't intersect with high-frequency trading. Internalization is the last great antidote against high-frequency trading in the marketplace.
So worry more about the Fed than worry about high-frequency trading.
Absolutely.
I don't know. We will certainly revisit the issue. Peter's rebuttal to Michael Lewis's book, again, is called Flash Boys Not So Fast. Thank you guys for being here.
Thanks, guys.
Thank you
Very much.